Most investors see double-digit interest rates and immediately walk away. But in high-stakes real estate, these loans are the primary tool used to capture deep discounts that traditional financing can't reach. Take a property listed $150,000 below true value. That gap represents a massive profit margin, but conventional banks need 45 days to debate tax returns. While their progress bar crawls, the opportunity disappears. A seller with a distressed asset isn't looking for the highest offer. They are looking for the offer that is most likely to close before a foreclosure or a tax lien hits. When the timeline is measured in days rather than months, standard bank loans become a liability. To secure the deal, investors turn to hard money. Hard money is short-term financing issued by private groups or individuals. It allows an investor to negotiate with the speed and certainty of a cash buyer. Private lenders prioritize the property over the borrower. While a bank looks at your debt-to-income ratio, a hard money lender looks at the equity in the deal. This is why a bank will reject a house with missing copper pipes or a failing roof. To them, the physical defects make the property unfinanceable. Hard money lenders focus on this math instead: purchase price plus renovation budget measured against final resale value. If those numbers show equity, the loan is approved. Because verification is tied to asset value, these fund in 5 to 7 days. Hard money functions as a high-speed financial bridge, bypassing the friction points of a standard mortgage to secure a property before the market reacts. Speed is the entry point, but the secondary advantage is the ability to maintain liquidity. Buying a property with 100% cash solves the speed problem, but it traps your entire capital reserve inside a single set of walls until that house is sold. By using a private lender's capital for the majority of the purchase, you can divide your own cash into 3 or 4 separate pools. Each pool acts as a down payment for a different deal, allowing you to manage multiple renovations at the same time. Scaling horizontally like this allows for a higher total return at the end of the year, even after the private lender takes their interest and fees. This use of leverage is what moves a participant from flipping an occasional house to running a consistent investment firm. This utility comes at a high price. Interest rates on these loans typically range from 10% to 13%. On top of interest, lenders charge points at closing. On a $200,000 loan, 2 points translates to $4,000 paid out of pocket on day one. Successful investors evaluate this debt the same way they look at a piece of heavy machinery. They compare the cost of operation to the value of the output. The most significant risk is the duration. These loans are short-term, generally capped between 6 and 18 months. If a contractor leaves the job or the local market slows down, that timeline becomes a threat. Every day the project sits idle, interest is eroding the profit margin. Missing the maturity date leads to extension fees that can quickly consume the remaining equity in the deal. You need a confirmed exit strategy before you sign. This means knowing exactly how you will pay the lender back, either through a sale or by refinancing into a long-term mortgage. Hard money is a specialized instrument, but when a purchase discount is deep enough, the premium paid for speed is simply a cost of doing business, one that secures a profit a bank-funded buyer would never have seen. If you are evaluating the numbers on a potential deal or looking to buy an off-market property, contact us directly to discuss your strategy.